Chapter 4. If you grow quickly, you can get bankrupt. Ooh, yes, that is true. I learned that in this chapter and I was quite surprised. Like if you are growing quickly, if you are selling more goods and services beyond a sustainable growth rate, you can become bankrupt. And that growth is no longer a blessing. Because when you grow and you sell more, your money is used in selling more. So more money is used to sell more. So it has a significant strain in your company's resources. So that's a key insight from this entire chapter. Growth is not always a blessing. All right, so let's get into proving this to be true, right? So, and that there is a need for this thing called sustainable growth rate. Sustainable growth rate is the maximum rate at which a company's sales can increase without depleting its financial resources, meaning without increasing shareholders' equity by issuing more shares, without increasing more borrowing, so without diluting. So if you increase more shares, if you sell more shares as a company, you are diluting your equity. If you borrow more money, you're borrowing, so your leverage increases, right? So without these two things, it's very hard for you to grow beyond in a way that's sustainable, right? So there is a magic number. It's called the sustainable growth rate, and we'll figure out how to get there. And typically a company goes from being a startup where it's a novel idea, it grows, there's an excessive growth, and there's maturity, and then it declines. And then at some point, they'll find its new idea, that new idea will grow, so it'll continue to grow, right? But remember, it takes more money to make more money, right? So that's the intuition, because if you want to build something more, if you want to sell more goods, you have to actually put your money in those goods to be sold, right? And you may not have that money in time. So every company has a target capital structure, which in a sense is basically what's the debt to equity ratio. Even here, we have to keep in mind that you can't have a single debt to equity ratio because over time, inflation eats into it, meaning it's going to cost you more money to replace the wear and tear of your plant. Maybe your salaries of your employees will increase. So it'll require you to borrow more. It'll require you to issue more shares because the employees require equity in the company, right? So it has to be inflation adjusted is my guess, which will come at the very end of the chapter 2. But there is a target ratio that every company needs to have, and that is decided by the management. What are they comfortable with, right? But in a sense, when you increase your sale, right? When you increase your sales dollars, that new sales that you're increasing is using cash, right? Because you have to pay the people who are selling more money because they're gonna ask you for more money for the deals that they've closed, the goods that have to be delivered, so more money to be producing that goods that are sold, etc. So there's new sales, so you're using that money. You're using more money to get to more sales. There has to be a source. Remember from chapter 1, 2, and 3, we've seen uses and sources of cash. So the way the money comes from is a source. So it comes from either borrowing or it comes from the retained earnings that you have used from your previous growth period, right? So the retained profits is nothing but equity part. So there's equity and there's debt part. So the new sales, the use of this new cash will come from these two areas. That's the sense. We've covered that previously. So if you want to find out this G star, which is the sustainable growth rate or the balanced growth rate, it's in a sense, it's basically change in equity divided by equity beginning of period. So let's find out how we get to this formula, right? So remember, when a company makes profit, whatever profit it keeps and plows it back into the business, that is going to be part of retained profits. And that profit is going to increase the equity of the company. So whatever the company keeps in its operations or reinvests in its operations, that is a change in equity, right? And if you divide that by the equity beginning of the period, that's your growth rate, because the more the money you put into your business, that's the proportion, the percentage. This is the percentage. The percentage of money that you're incrementally adding into your business is the percentage you can expect to support your sales, right? So if you're adding more into retained profits are kept and not distributed to your shareholders, then that can support the new sales. So that's how we get the sustainable growth rate, right? This assumes that you're not borrowing more money. You could do that too. You can say, hey, I'm gonna increase my sustainable growth rate by borrowing more money. Let's assume we don't want to do that. Then a sustainable way is to use the cash flow from your operations, right? And then whatever money you have kept as profits, you use that to increase your retained profits, increase your equity. And that is a sustainable ways. You can do that for an infinite period of time, right? So that is the intuition behind how we get here. G star, sustainable growth rate, is change in equity divided by equity beginning of period. It's a fraction, it's a percentage. Now, if we see as equity grows, retained earning grows, your ability to borrow also grows, right? So your target capital structure changes, because if this portion expands, then you can actually expand and take more debt. But it doesn't mean that you take that much debt. So if we now continue to build on this equation, G star, sustainable growth rates, is earnings retained in the business, which we saw, times retention rate divided by equity beginning of period, right? So change in equity is nothing but earnings that are retained times retention rate. Because you will sometimes want to give out those dividends, so it's not retained. So the portion that's interesting is earnings that's retained times retention rate. That's the change in equity. So this is nothing but change in equity divided by earnings beginning of period. We know from the previous second chapter, return on equity is earnings retained in business divided by beginning of period equity, right? So this is nothing but return on equity. And we also know return on equity from chapter 2 is from the DuPont identity equation. It's profit margin times asset turn times leverage, right? Leverage ratio or asset to equity ratio. So PAT, right? So if we now combine all of this, we get G stars equals ROE times retention rate, right? Because this is ROE times retention rate. And we know ROE is PAT, so PAT times R. So this is the magical formula. If you want to find sustainable growth rate of a company, you use G star equals PATR. Profit margin times asset turn times asset to equity times retention rate. This is the percentage that is the maximum sustainable long-term. You can grow at this rate, not below, not above, right? If you do that, then you're not eating into cash, or you're not hoarding more cash or generating more cash than you need, right? So G star, calculating G star is very important for us to assess what the company should do. If it has more cash, what it should do, what are the levers? And these are the 4 levers, right? So now let's look at two situations. You have too much cash, or you have too little cash. If you're too little cash, meaning you're too much growth. You have too much growth, so meaning you're always losing, always needing more and more cash. So now let's look at if you're in too much growth situation. So the first step in all of this is the management. The leadership team needs to recognize that, hey, there's this thing called I'm in this too much growth phase, or I'm in too little growth phase, right? And the management needs to know, like, as we saw here, are we in the startup phase? Are we in the growth phase? Are we in the maturity phase? Or are we in the decline phase, right? So that's when you need to diversify, get into better businesses. Otherwise, shareholders will leave, sell your stocks, right? So the first step is for leaders to recognize which phase are we in. Once you recognize that, then you can have a viable strategy. But if management cannot anticipate where they are and cannot actually fix the problem of where we are today and what is sustainable rate and how do we bridge the gap, then that's a problem. But now you know how to fix the problem, because now you know there's this concept called sustainable growth rate, right? And we know that it's the formula is G star equals PATR, right? And we know also return on assets equals profitability times asset turn, right? So we can also say G star equals return on assets times leverage ratio, asset over equity ratio times retention rate. So now assume the retention rate is 25%. You say you you give out 75% as dividend, but you only keep 25%. So R is 25%. And let's say your leverage ratio is 1.6. So asset over equity is 1.6, right? That's your T. So then your G star equals 25 by 100 times 1.6 times ROA. So it's 0.4 times ROA. So G star equals a linear relationship with ROA, right? 0.4 times ROA with these ratios. So you can actually plot this. You can actually plot this saying, hey, if ROA is on the x-axis and sales, this is percentage sales on the y-axis, then you can say G star equals 0.4 times ROA. So this line is basically your sustainable, this black line is your sustainable growth rate, right? And so above it, you're in cash deficit, meaning you need more cash, you're growing too quickly. Below this line, you're cash surplus, right? But there'll always be times when you would be, you'd have unbalanced growth. Sometimes you might have sales growth grow from 10% here to 20%. So then this ratio, then your G star will become 1.4 times ROA, right? Because let's assume then that you have to now for supporting that sales growth 20%, you need to increase your retention from 25% to 50%, and your asset turn from 1.6 here to 2.8, right? So double both of them. So if you double both of them, then you can actually double your sales growth, right? So it's simple. So you changed your black line sustainable growth to this blue line sustainable growth and you could only increase from 10% to 20% when you actually increased your R and T. Remember that? Yeah. So you have to change these areas, right? So when you have to increase your G star, these are the 4 variables, 4 levers. That's it. 4 levers. If you're having sustained growth rate issues or either higher cash or lower cash, you can increase your levers. You can say, hey, I need to not give out more dividends, or I need to be more efficient in my operations. And that's what these 2 ratios are. So we see that with an example is given as well, wherein there is where in table 4.1, sustainable growth rate, an example is given of company Medifast Inc., right? And so we see that the sustainable growth rate is actually much lower than the actual growth rate. By that, what I mean is this is their sustainable growth rate, but they're growing too quickly, right? They're constantly in deficit. So then what happens? What did they do to actually get there, right? So to support this growth, what they're doing is they're increasing their asset turn almost 2x. Remember, those are the 4 levers. You can increase your asset turn, increase your retention. Only then can you actually sustain. And you can do what if calculations. So if you're a company and if you're having too much growth, meaning you're deficit in cash all the time, then you can figure out for the next year's projections, like, hey, if my profit margin's this, if my financial leverage is this, and if you multiply all of these 4, you will get sustainable growth rate. And then you will know what you need to change. Which of these ratios will have to change so that your actual growth rate matches your sustainable growth rate. Because if you don't do this over a long period of time, and if you just keep ignoring it, you will be constantly in a cash deficit area. You'll see in 2006 they were needing, so the sales growth was close to 50%, but it should have been close to 10. In 2007 it was 90%, should have been close to like 15. But see, that's the ratio where they should be, but they've been constantly above the line. When you're constantly above the line, you need to figure things out. And how do we solve for this? There are like multiple ways, and there are, in the book we have these 6 or 7 ways given to solve for when your growth in sales is way high. You need more you need more cash than you can generate, and your sustainable growth is much lower than your growth in sales. If there's too much growth, what do? There are 7 ways given in this chapter. But before you go into using the 7, first question you should always ask yourself, is this surge temporary or permanent? Because if you might have a temporary need of cash just for 1 year, then you can just borrow more money, and then next year when you don't need that money and you're generating cash, you just pay off your debt, right? So the first thing to do is assess, is this going to be temporary or permanent? If it is permanent, which is in this case, like it's going on for years, right? So if 2006 they didn't realize, they should have realized in 2007, like, hey, this thing is not working, So then what you should do, you have an option to sell and sell equity, issue more equity. That's the source of cash. You generate cash by selling more equity. You sell equity, more shareholders come into the market, they give you cash. You increase borrowings, so increase your leverage, source of cash, right? So where do you get money? You get money by selling equity, increasing leverage, reducing your payout, right? Instead of giving dividends, just cut back on dividends, use that money. Profitable pruning. This is a really critical and interesting idea, which is like just get rid of slow paying customers or less profitable customers or slow moving inventory, just marginal products, very small. Just get rid of them, because it's very hard to compete in multiple product lines anyway. So just get rid of your marginal businesses. Makes you focused on fewer things, right? Finally, if you want to save money, outsourcing. If it's not your core competency, you can actually send that work to lower paying countries where you can get the same quality of work for a much lower price. Zoom used this, right? Zoom, when it developed, majority of its engineers were in China, 1/3 the cost in the United States. So they were able to compete because outsourcing, right? Increased pricing. Increase your prices, marginal customers will fall off. Your money will not be, wasted on them. Your growth will slightly reduce, right? So you're actually reducing your sales, right? Because you're increasing prices. So percentage sales growth will reduce. Merge with someone who actually has an opposite problem. Like if you have like a big company who's generating a lot of cash but has no way to solve for their issues, merge with them best, right? So 7 ways in which if you're in a cash deficit situation, you can take action. All right, so let's get in the next part. Too little growth, right? Too little growth. Opposite, right? You're this monopoly kind of a business, you're generating too much money, you have no way to use that money, too little growth, right? And so the equation would be the opposite, meaning the sustainable growth rate is this black line here, but you are actually here. You're generating sales much lower than what you should be, right? So you have a lot of cash surplus, right? So what do you do when you have this cash surplus? Again, there's this example given in the book. If you see that asset turnover reduced, right? They reduced their turnover. They just got more sloppy, right? You have more money, you can get more sloppy, right? And financial leverage also reduced, meaning pay down your debt. You just don't need to borrow because you can reduce that, right? So you can exact opposite problem, right? And so when there's too little growth, there are also there are 3 or 4 ways to solve it, not really 7 ways. When you have too little growth, again, first, step back, check. Temporary or permanent situation. Temporary, none of these things apply. Temporary, ignore, right? If it's too little growth, save more money, use that money, and no one will even care. But if it's permanent, don't ignore the problem. Because if you ignore the problem, if it's permanent, meaning in this situation, 5 years, you're just not growing what you should be growing, then you will attract activist shareholders who would, take a very sizable stake in your company and then kick you out as a CEO or the board, or they'll replace the board and then they'll use the money, right? Because there's enough money, they can actually generate more return. So you will attract activist shareholders who would actually take over your business if you are ignoring the problem. But remember, you only invest money into the company's newer areas if your return on your capital employed is greater than the cost of capital, right? Meaning, if you're investing in something just because you have too much cash, but if it's returning less money than if it like your cost of capital, which is like if you just kept the same money in a bank and you would have gotten more money, then it's not a wise use of money. So you should only invest if return on capital is greater than cost of capital. That's the first problem. Ignore. If you ignore, there's a problem, right? So you can't ignore. So that's not really an option. Ignoring the problem, not really an option. The only real way is to return the money to shareholders. How do you return money to shareholders? You pay back dividends. You increase dividends. Like, hey, I have extra cash. I'm gonna just give you money. This is actually looks attractive, but it's very, very problematic. I'll tell you why. If you increase dividends, now all of a sudden you attract shareholders who expect dividends. They're like, hey, I want dividend paying stocks, so I'm gonna buy this company. And when you stop or when you want more cash, they'll just bail you, and then you'll have a pressure on stock sales. It could have a negative impact as well. Also, when you give out dividends more and more, or when you purchase your shares, is another way to reduce. You use your cash to retire your shares, or buy out some shareholder. It's actually hinting towards the management's failure of capital allocation, right? Actually, it's good. It's actually the best way, instead of just investing into something that returns lower than the cost of capital. But it hints to your failure. You as a new manager, you are not able to use the money, so you're returning the money. So why should I be investing in you? Yeah, it's fair. And also psychologically, right? Like people build empires, is what's given in the book. It's true, right? And so there's a human nature. So if you give money out, you're actually reducing your empire, right? So you're reducing your capital that you have to manage, right? Also, if you give money out, if you don't invest in newer growth opportunity, you lose key people, because they're like, hey, I'm here to grow, right? I want initiatives that I can do something new. So while this is the least favorite, this probably is the only way, right? In of the two, which is dividend, or pay out dividends and repurchase shares, right? But there's a third way, but even worse. This is M&A, right? You buy out companies which are high growth. The opposite. You remember the previous set of companies which were like high growth, always needing cash, right? The problem here is that most of these deals, M&A deals, if you analyze them, they're already too premium of a price that you have to pay. It's very expensive. So you get them at the very top end, and now you're acquiring the company. Unless you see like a huge acceleration that is synergistic to your business, this would be very expensive. The examples where this worked really well is Facebook and Instagram. 1 billion, they paid for it, right? Huge. At that time, it was an outcry. You paid 1 billion for like 12 people company, and Instagram is huge today for Facebook. WhatsApp, again, huge amount of money paid to buy growth, right? And competition. So there's some really good examples, but most are bad examples. When you buy companies because you have extra cash, better is to just return that money to shareholders, unless you find better, really synergistic, concentric areas of investment, are very close to your core competency. Give money back, right? The final key takeaway is when we covered this at the very beginning, is think about inflation. This is going to cost you more money to replace your wear and tear of your assets. Salaries will go up. So you can't really keep the same debt to equity ratio. So it's important to inflation adjust it, and make sure that it is it's factoring in inflation, right? And so there are two key things we've learned so far that helps us analyze pro forma financials in the previous chapters, and in this chapter, sustainable growth rate, right? And we've come up with a formula. We know how to use it. Sustainable growth rate, it simplifies this into this one equation, G equal to PATR, right? It's like the big picture, the forest. You can get a big picture and quickly understand, okay, what are the variables I need to go and change so that I can actually be sustainable in my growth. But pro forma is where you get the details. Actually, like, find out where the actual problem is. You can actually drill in. So those are really good tools for us to use to get better at finding out how to manage growth, right? And to end with this, right? Growth is not always a blessing. You can become bankrupt. Now you know why.